How would you like to grow your tax-free wealth through real estate? Paden Squires will tell us how to do it. And he is an entrepreneur and founder of Squires Tax Planning. His mission is to help entrepreneurs just like you to pay less in tax and to grow your property portfolio through that. So, Paden, tell us more about that.
Property Wealth Strategies podcast with Lily Patrascu shares world's most influential property investors, sharing their strategies for making money with property.
Yeah. So, obviously my background's in tax and wealth as a CPA and CFP. When it comes to real estate investing itself, real estate investors have some of the best tax advantages out there, right? There are a lot of opportunities when it comes to properties and real estate, as investors to be able to grow your wealth in a tax-free fashion to where you're not necessarily recognizing income from year to year and having to pay taxes on it.
Thank you. So tell us more about your blueprint for someone to grow their tax-free wealth through real estate. What kind of techniques or methods would someone need to look at in order to make this happen?
Yeah, that's a great question. First off, it all starts with really just self-education. I'm a big believer in continuous development, self-education. If somebody hasn't done anything in the real estate space whatsoever, start reading books, start following podcasts, start to soak in a lot of that information so you understand how the game kind of works. Once you jump into it, it's just dabbling in finding maybe a small property to start with. But getting in the beginning, it's like you really need to go into it with eyes wide open and understand that, investing in real estate isn't necessarily this completely passive thing. It's a business. You're going to have to be involved. There's going to be a lot of work to it. But there are a lot of advantages to it to be able to grow like you said, to be able to grow your net worth without necessarily having to pay taxes on it.
Thank you. Is there any specific method you want to tell us about? So just imagine you're dealing with thousands of savvy investors that are watching our show. Yeah. So what kind of techniques don't they know already that you might be able to tell them about?
Yeah, a couple things. One tactic, I guess you'd say, is short-term rentals, right? So Airbnbs, VRBOs, those types of investments, have really taken off in the last decade or so. The cool thing, and the reason I bring those up is there's tax advantages to be involved in an Airbnb or VRBO. If you know anything about income taxes, generally real estate income is what's the IRS categorizes as passive income. And when you have losses in real estate, they're categorized as passive losses, meaning your passive losses don't necessarily offset your W-2 income or other business income, your active income that you have going on. That isn't the case when it comes to short-term rentals, as long as you're actively involved in them. If you're actively participating in your short-term rentals, they can, that is categorized as active income with the IRS if you meet certain stipulations. And with that being the case, is you can use losses from your Airbnbs to offset, W-2 income or business income. And okay, well, how do you generate losses, right? So one of the main strategies is coming into buying Airbnbs is to do what's called a cost segregation. A cost segregation in real estate allows you to really accelerate the depreciation of the asset you just bought and really pull all this expense that would be in later years through depreciation and really pull a whole big chunk of it into year one. And often that can create, you can, let's use round numbers. You can buy $1 million property. You can write off anywhere from 20 to 30% of the value of the property in year one through a cost segregation. Now, there's some caveats to that, but generally speaking, 20% of the property value can be written off in a cost segregation. So you think about that. You buy $1 million property. Heck, let's say you buy it in December and you buy it right before the end of the year. You buy $1 million Airbnb. You can do a cost segregation on that and get something like a $200,000 expense in year one. And if you have other W-2 income and business income, that's going to offset that income.
Thank you. What about for short-term rentals that you don't own? I don't know what whether that's something that people do in the U.S. where
Yeah,
you
I
rent
think it's
out.
like subleasing and stuff, right?
Yeah.
I've read about some people doing that, right? Well, they'll contract on a property and do a long term lease and then try to make the margin, right? And the difference by
Yes.
Airbnb and it, like subleasing it out. I've seen a lot of people do that. Certainly that carries a significantly more risk, I would say, in it, just because of the way that's structured, because you're just trying to make a margin off of, the long term versus short term rental. But like, I know there's plenty of people that are successful at doing it. It's just a little different game.
Thank you. So my question was, is there anything that property investors investing in short-term rentals that they don't own, any method in terms of tax planning that they could think about that they can leverage? And
Yeah. So
imagine they don't have any losses. Unless you
yeah.
tell us about some losses that we should consider that we are having. So imagine you have a
Well,
really
yeah.
profitable business, okay?
Yeah. Well, and when I say generate losses, it's really generating paper losses or tax losses. It's not, your Airbnb can be very profitable and you do a cost segregation and you have a massive loss when it comes to your tax returns. So,
Yeah.
it can perform well and you still create a loss. Specific advice for, people who are doing that, you're generating rental income, right? Like if you're profitable, you're generating passive rental income on your tax return. If you're playing in the short term rental game, maybe even looking into some long term rentals as well, because the kind of idea and the advice I give to real estate investors is like, as long as you continually buy and continually grow your portfolio, you're constantly going to have new properties that you can do cost segs and stuff on that maybe offsets your income that you have on your other properties. So it's a game of just constantly, reinvesting and buying more properties. And as long as you play that game, you can do this in a way that very little income ultimately shows up on your tax return.
Oh, okay. That's very interesting. Tell us about what other types of methods should property investors look at when it comes to their tax planning and growing their tax-free wealth through real estate?
Yeah. Great question. One big qualification, if investors can hit it, is what the IRS calls real estate professional status. And this is an IRS definition. If you can qualify for real estate professional status, and it could be either spouse on the tax return, as long as one spouse qualifies, the whole tax return qualifies. To do so, you have to spend a minimum of 750 hours in real estate, like activities. And you can't do anything more than you do. You can't do other activities that take more time than your real estate activities. So real estate needs to be your main thing that you spend time on, and a minimum of 750 hours. And that will get you real estate professional status. Why is that important? It's important because if you're a real estate professional, when I was talking earlier about passive losses not being able to offset active income, none of that applies if you're a real estate professional. So if you're in the business of real estate and qualify for that status, you can take passive losses on your real estate, like long-term rentals or any type of rentals, and offset your W-2 or business income, or your spouse's W-2 or business income. So that's a huge qualification if you can hit it. There's a lot of spouses that one spouse is the main breadwinner, makes a bunch of money on a W-2 or through a business, and then the other spouse, manages properties or whatnot, does enough to qualify for that real estate professional status, and then all the options are on the table when it comes to tax savings at that point.
Thank you. So let's say someone who is a property investor and wants to take advantage of all of these different methods. I'm assuming that their specific circumstances, will kind of need to be checked out by a professional, because, they might hear of these things, but they may not apply to them and this kind of thing. Where could property investors find out more about how to grow their tax-free wealth through real estate? Are there any courses or books or any information you have about that?
Yeah. So, overarching, when you hear tax advice or financial advice or whatever on the internet, right? Like everything it needs to be taken into account in your specific situation. So, I get on podcasts like this and I'm kind of talking in generalities, but you really need to be able to check out and make sure you look into this stuff for your specific situation. And what I would tell you is that, there's a lot of great resources out there. Tom Wheelwright, I don't know if you ever heard of him. He's a CPA, wrote, I think the book's called Tax Free Wealth, but he's kind of part of the rich dad, poor dad kind of group. And, he's been out there for years and years talking about, real estate type planning opportunities, kind of some of the stuff we talked here. But like the biggest thing is finding a professional that is a tax planner versus just a standalone tax preparer. The vast majority of CPAs and people in the tax space across the country are really focused on just prepping the taxes, right? There's very little strategy or forward-looking, advising going on there. So I'd really encourage anybody, and that's how we've set up our business model, is to really be that proactive. We meet with all our clients multiple times throughout the year and really doing this in-depth planning. I would encourage anybody that really wants to get strategic about their taxes and really just growing their wealth in the most efficient manner is finding professionals that actually do that. Because many professionals will just, take your money and, prep your taxes and whatever. And that there's nothing wrong with that. It's just don't go into that situation and expect you're going to get, all this strategic stuff, because you're probably not.
Thank you. Is there any way for property investors to leverage debt in order to grow their tax-free wealth? I mean, like, I don't know, credit cards or loans, or I don't know, anything else you can tell us about related to this?
Yeah, the use of debt in real estate is actually what makes it a more attractive investment. It allows you, the cool thing about real estate is, generally prices are stable in real estate, right? They move a little bit, but they're mostly stable. They kind of generally just appreciate over time. But what the reason I bring that all up is because it allows banks to lend on them, right? Like banks have no problem lending on real estate, any day of the week, as long as the numbers and stuff make sense. So it allows you. So for example, you're going to go buy $1 million property as an investor. You really only have to come up with $200K or something, right? Like whatever the down payment is, and it allows you to use other people's money, right? The bank's money, or maybe owner financing, or whoever else, to get control of $1 million asset, and it only costs you $200,000 to do that. And of course, if you buy into a good enough situation, ideally $200,000 is all you ever put into the deal. You own it forever. Like the debt gets paid down by the renters, and hopefully you're capturing appreciation as well. So it's leveraging real estate is really what makes, in my opinion, the investment attractive. If you were just going to kind of acquire real estate, with pure cash all over the country and just buying stuff with cash, probably not a bad investment, but it's not going to give you that necessarily higher return that you might be looking for.
Thank you. Are there any ways to leverage debt and that you have on a property in multiple ways? So that, I don't know, let's say you buy a property and then you use the debt that you already have to buy more property. Can you tell us more about that?
Yeah, I mean, one really basic strategy, I guess you'd say, is make sure you have line of credits on stuff. So, for example, in my own personal situation, I have my own residence that has enough equity in it that I have a HELOC on it, a home equity line of credit. And, with that, it gives me the opportunity to write a big check at a moment's notice, right? Like I have a home equity. It's almost like a credit card kind of attached to the equity that you have in your house. So it allows me to, like, at a moment's notice, I can write a 6-figure check if like an opportunity comes up, right? Like where I want to quickly jump on an opportunity, I can just write a check at any, moment's notice and tack that HELOC. So it gives you flexibility, it gives you access to cash quickly. Like, sometimes it's real estate deals, if you can move quickly and get into a deal, you win it versus somebody else, right? So it's getting your financials in a position to where you can move and act quick when big opportunities show up.
Thank you. What about property investors who live abroad and are thinking of coming to the US to invest in real estate? Do you know of any opportunities they can leverage they may not be aware of because they don't know anything about the tax planning in the US? So
Yeah.
they can grow their property portfolio. Imagine they already have properties in the UK, and then
Mhm.
they want to leverage that, or perhaps some of the money they have there, in order to kind of start moving their assets into the US. Is there anything at all they would not perhaps know about that you can
Yeah.
tell us?
Yeah, and I would say is they're generally going to be jumping into the same game that everybody here in the United States is doing, and more or less, got to follow the same kind of rules. If there's international people that are looking to do that, once again it comes back to make sure you do your homework before you start doing anything, because imagine it's hard to manage properties in different towns, let alone across the Atlantic Ocean, unless you have systems and stuff in place, right? So, I would encourage anybody to really, I don't have any, great specific advice other than make sure you really know what you're doing before you jump in or write a six-figure check or something to buy property in a different country. Make sure you've really done your homework there. But with all that being said, it very well could be, an attractive investment for an international person.
Thank you. I've had quite a lot of US guests on, and so I'm kind of gradually learning about the US market, the property US market. Is there anything else you could share related to entrepreneurs who want to invest in the US real estate market in terms of trends? For example, like right now, I think, and you can correct me, I think the properties are going down when there's like less demand for properties in the US
Yeah.
on a temporary basis, probably. And is there anything that property investors can do to grow their tax-free wealth through real estate, leveraging this specific trend of properties going down?
Yeah, yeah. So, when I talking about real estate and people say the real estate market, in my opinion, there really is no like national United States real estate market. Real estate markets are all very local, meaning like they're subject to the supply and demand of what's going on in that city or that general area. Property could be dropping in value significantly, say on the West Coast, but on the East Coast, it's going up quite a bit. Like they're not necessarily all tied together. Now, there are big generalities that affect the whole real estate market, like, interest rates and just macroeconomic pieces. But then at the same time, real estate prices are really just driven off the supply and demand in that local area. So it's, if you're an international investor, it's kind of doing research and looking at maybe major metropolitan areas that people are maybe moving to. Over the last decade or so, it's been Texas, the state of Texas. Nashville in Tennessee is a bit of a big one. It's really you've seen a lot of real estate. Honestly, the growing areas are areas that are generally less regulated. And by what I mean by that, they're generally states that are more business friendly. And for example, I gave the example of Texas and then Nashville, Tennessee. Both those states don't have state income taxes. There's about 10, 12 states in the United States out of 50 that do not have income taxes, which is the opposite. Like you go to California or New York, I mean, their state income tax rate. You got federal taxes, which could be anywhere from 20 to 40%, depending on your personal situation, and then you have state income taxes on top of that. You go to California, New York, I mean, it could be 10, 12% additional. You go to Texas and it's zero. You go to Florida and it's zero. So it's just knowing that, especially if you're international, because if you buy real estate over here, United States is going to want a piece of your income for sure.
Thank you. Tell us more about leveraging your existing property to buy more in terms of like using the equity to buy more, or if you think you've already covered that, tell us more about, is there any way to like leverage credit cards or other loans to buy more property?
Yeah. Yeah. I mean, being able to tap loans and other people's money is kind of the whole game of real estate, and being able to use other people's money. And you obviously overarching, you need to be careful about that. And meaning like people get themselves in trouble with debt all the time, right? Where they don't know what they're doing and get themselves in a position to where it just kind of all blows up and they lose everything. So you can easily get yourself in a position where you get out in front of everything and you can't pay for it, and then guess what? The whole thing comes collapsing down, and you lose everything. So you really got to be careful about using debt wisely. But with that being said, you say people with multiple properties. I have a lot of real estate investors as clients, and it's very common for banks to give them like portfolio loans, meaning like you have a big loan and it's attached to several different properties, and typically there's equity in there. And overarching, especially in the United States, I would say it's building relationships with banks that know your situation, loan officers that really know your situation. I have relationships with local banks that, I can call them up and be like, hey, I'm going to make this move. They know enough, we have such a personal relationship. They know enough about, my personal situation and what I'm doing, and they trust me. And it's like, hey, yeah, go for it. We'll yes, they still need to do all the loan paperwork and whatever, but they know they can do it. So it's like, I can move quicker than maybe the average person.
Thank you. What does it take to build that kind of relationship with banks where you're able to make that kind of call so that you could get financing for your property portfolio faster?
It's, just years of consistency, right? You get in the real estate world, you can kind of show to the banks that, just through your performance of like, hey, I kind of know what I'm doing here. I'm experienced and whatnot. I'm not just, somebody showing up to buy a piece of real estate and doesn't really know what they're doing. And it's just building those relationships through that of showing the people that you're serious and whatnot, and doing a deal with them. And, once you get a couple deals down the road and they see they're all good, they're going to be a whole lot more likely to just jump in with you quicker.
Thank you. In terms of like building your credit, is there something you can tell us about that for someone to grow their tax-free property wealth? Or is that out of your...
Yeah. So if you want to be in real estate, your credit score is important, right? Like it just flat out, it's going to affect interest rates and what all banks are going to be willing to do for you. So it's very important. If you had some issues on your credit in the past, it's a matter of just addressing those things, right? Pulling your credit report, taking a look, see what's out there. Some of the stuff you can just get it flat out removed if you reach out to the credit report agencies and dispute it or whatever, and this stuff will just disappear. But other than that, I mean, like a way to build your, credit or to get it better is just, have a credit card, run some money on it and make sure you pay it off every month. Cause then you're giving the credit agencies history of, showing that you can handle debt and whatnot. And that alone could help your credit report. And other, there are people there are professionals out there that live in this space deeply of credit reports and credit numbers. And there's experts out there that, certainly know a whole lot more than I do about, okay, what specific things can we do to make this, this number go up? So if that is a serious issue for you or whatnot, that might be holding you back, it's looking into some experts out there that work in that space to help you rapidly improve your credit. But yeah, you need good credit if you want to do real estate, in my opinion.
Thank you. Tell us more about where entrepreneurs can connect with you so they can find out more about how to grow their tax-free wealth through real estate.
Yeah, absolutely. So, I own and operate my own tax planning firm here in mid-Missouri, so right in the middle of the country. You can connect with me at squirestaxplanning.com. You're interested in talking about tax and wealth and the efficiencies of doing all that. We do all that stuff at a very high level. I ran my own practice for a little over a decade now. On the flip side, you check out PadenSquires.com. That is kind of just my personal brand. I also do podcasting myself. I have a podcast called Behind Their Success, where I interview 8-9-figure business owners from all over the United States and talking about their stories and how they built what they built, and just a lot of cool stuff there. That's not really necessarily tax and wealth focused, but it's really like mindset and entrepreneurship focused. So On the tax and wealth side, you can check me out at squirestaxplanning.com on like podcasts and personal branding stuff and entrepreneur type stuff. It's PeytonSquires.com, or check out the podcast behind their success.
Follow me for more property wealth strategies.